Welcome to CLIC Connect. I'm your host, Craig. We've got another first-time guest and an industry leader. We're going to be talking about hotel loans, financing, construction loans, and so much more today. But before I bring our guest out, I would like to thank our good friends at Red Roof Franchising. Give Matt Hastadler a call. He would love to hear from you. Him and his development team, they've got a soft brand, they've got their extended stay, and their world-famous economy brands. They would love to talk to you. If you're looking for conversion opportunity, they've also got a new prototype out. So give Matt a call. Let him know that producer Danny and I sent you. They would love to hear from you. And March 5th and 6th, 2025, the 8th Annual California Lodging Investment Conference. Join us in beautiful Long Beach, California at the Westin. You can register at cliconference.com. Use the promo code EARLY, all in uppercase, and you'll save $200. It's a limited run on that discount, so I'd register as soon as possible. We look forward to seeing you at CLIC 8. Thank you. No further ado, we're bringing Ryan Bosch. He's a principal, Arriba Capital, to the screen and to the talk for the first time. Ryan,
what
welcome.
An intro.
How are you?
I'm doing great. How about yourself, Craig?
Great. It's good to see you. It was a pleasure meeting you at the lodging conference and getting a quick on-the-spot interview there. And I said, got to get you on the show. And here you are. So thank you.
No, likewise. It was fun.
Hey, do me a favor, please. Would you tell the audience about yourself and your company?
Yeah, absolutely. Ryan Bosch. I'm a principal with Arriba Capital. We do debt and structured finance, specifically for hotels. We finance about $1 billion in hotels a year, and across all situations. So we do quite a bit in ground-up development, construction, permanent financing, bridge financing, and equity as well.
Love it. Love it. So we had another quarter point cut.
We did.
Maybe it moves the needle a little bit more than last time, but I think every time there's some fluctuations, either up or down, you as a principal get busier. Typical sources of capital can dry up. They don't know everybody. Their relationships aren't there for the time being. The rate environment going into 2025, Fed cuts, Treasury rising. What are you thinking about all that?
So it's interesting, right? And it's something I haven't seen in quite some time, where we've got two things happening. We've got the Fed cutting interest rates, and they just did a 25 basis point cut. Market's predicting another 25 basis point cut in December, and then we're expecting another 50 basis points after that throughout 2025. And when I say we, that's what the market's expecting as of today. The opposite end of the spectrum, we've seen, post-election, the Treasuries kind of pop and skyrocket. So I think in the last 40 days, Treasury rates have gone up something like 30 basis points in total. So it's kind of this interesting situation where we're getting relief on short-term rates, right, that are more aligned with, Fed cutting rates, and our long-term perm pricing on rates has been actually elevating at the same time frame. So we'll see how that all plays out going into next year, but I think we're in for a long ride. I think the market's going to be kind of up and down when it comes to rates, but I think generally we're going to be within 100 basis points of where we are today.
I have to agree with you on that. I was really happy with the quarter point. Okay, when we hit the half point, a while ago. That wasn't enough really to move the needle anywhere, I don't believe. And I think this quarter helps. It's a beginning. It's not the middle or the end. And I agree with you. I think there's going to be another 50 bip cut, sometime next year. Now, whether that's the end of it or if it's more, who knows at this point. But I think you're right about, everything that you're stating about the market. And I think that also validates my opinion of mortgage brokers and people who can do structured financing out there for everybody, because now you're the best source of capital. You're the best source of debt and equity as well, because you've got your fingers on the pulse of what's going on, not just in Arizona where you're based, but across the country. you've got access to Wall Street, you've got access to private money, and so on and so forth. So with that said, how are the developers navigating interest rates right now on construction costs and the current lack of equity?
Yeah, so it's interesting, right? I think if you look at the challenges developers are facing, it's kind of a two-pronged thing here. We've got elevated interest costs from what it's been, and then at the same time, we've got elevated construction costs, right? So if you look at how much construction costs have gone up, it's been over and above inflation every year.
Yeah.
Right. So the combination of those two things, it's definitely making deals tougher to pencil. And then at the same time, to your point on the equity side, as treasuries get elevated, that risk-free rate of return, right, for investors is elevated. So when you look at the capital allocation out there, especially institutional money, they're not chasing 20% IRRs in development when they're getting 5% free money on treasuries. Not that that's what it is today. So we've seen kind of a move in where capital is being allocated, and we've also seen a lot of capital flow into private credit, right? Where guys were investing on the equity side for development deals, stabilized properties, and now they're allocating bigger portions of their capital into private debt funds, right? And getting equity-like returns there. So, the short answer is developers have a bunch of issues that they're facing every day. The good thing is, I think the positive thing, we're still seeing deals pencil on a daily basis. I don't think it's as easy to develop today as it was 5 years ago by any stretch.
Right.
But I think development really comes down to what's happening in your submarket, right? You can look at all these macro trends and try to come up with a thesis based on that. But if there's a gap in your submarket where demand's outpacing supply, chances are that deal is still going to pencil, right? So there's deals of every level from the economy stage up to full service that are getting done on a daily basis. I think the returns are down from what they were, just given where construction costs and rates are, but they're still healthy and there's still equity out there for those deals.
That's good to hear. I think there's also a couple of other problems out there that really aren't getting a lot of discussion right now.
Mm-hmm.
Basically, every state in the union has been affected with disasters, and we see that number going up every year, whether it's wildfires here or if it is flooding and hurricanes, Florida and the Southeast. And you're right, construction costs have gone up, and I'm hearing little blips here and there of people going, well, not all materials, some have come down. I'm going, yeah, but concrete hasn't. Okay, wood possibly. I'm not seeing a lot of savings on steel right now either. But my bigger concern is the qualified people to build the project, because they're either in Lahaina, they're somewhere in Tampa or somewhere else in Florida or the Carolinas or someplace else. And we've got other construction companies that have pulled out of hospitality to work on multifamily and a few other things. So I think, now according to Logic and Econometrics, you've got the Inland Empire as one of the top new construction markets in the country for hospitality assets. So, that could be oversupply coming. I'm not sure yet. I still think my personal barometer is not set on that yet, but I think there's a lot of issues there with construction that insurance and everything else that are not being talked about yet, and they need to be. I mean, you're seeing this on a construction loan. What are the reserve requirements now?
Reserve requirements as far as interest reserves, as far as replacement reserves, like
replacement and interest, actually.
Yeah, I mean, well, interest reserves, it's really just coming down to draw schedule, right? So as interest rates are elevated, you're calculating to have enough interest to cover you until the property has cash flow, right? So that fluctuates on a deal by deal basis. The gold standard in underwriting for FF&E and CapEx reserves is 4%. That's what's still being used just about by every underwriter today.
Okay.
If you talk to any asset manager, they'll tell you they end up needing more than that 4% in FF&E reserves.
Yeah.
But that's still what we're seeing being underwritten on a daily basis from lenders. So nothing's really changed there. I mean, to your point on insurance, I mean, not just on construction, on acquisitions as well, right? It's a big issue and becoming a bigger line item on the expense side than anyone anticipated. Especially markets like Florida, California. How that gets solved is way above my pay grade. But you definitely, it makes it more challenging doing business in those areas, right? Like an example I'd give is, we did a construction project, and I won't name the brand or location, but it was beachfront on the East Coast, a Residence Inn in the last couple of years, and our builder's risk insurance on that project was $850,000.
Ouch.
Yeah. Ouch. So 3 years prior, we probably would have paid $250, and we thought we'd be paying too much. So I mean, that gives you just kind of one indicator of how out of control insurance costs have gotten, especially in Florida.
Yeah. That's, you mentioned both markets, California and Florida, and I think they've got to be the two worst markets out there right now for insurance.
Absolutely.
I deal with, and wanted to sponsor my conference. Gallagher is actually taking people over to Lloyd's to meet them so that Lloyd's could hear their story, because they had received a huge bump from their current carrier, and they were able to work it out where it came in at less, and everybody walked away reasonably happy. So again, it's the relationship with you and your firm to get the debt and equity together and structure that deal, and the insurance carrier that you're going to need as well. So what's happening in your opinion, with the record number of new supply in the pipeline, but the muted supply growth in all the forecasts?
Yeah, I think there hasn't been a study that I've seen on this, but yeah, we've got a record number of projects in supply. I think I'm looking to the side here because I made a note of this. 6,100 projects as of July that are in supply today, representing about 713,000 keys. So that's what's in the pipeline. There's a lot of projects that I'm aware of, just on a personal level, that have been in that pipeline for quite some time, right? Yeah. So the question becomes, how many of those projects are going to actually break ground, move through to completion? I think the jury's still out, right? When you look at the increase in supply projections over like the next 3 years, it's extremely muted. I think it's below 1% in most submarkets. I think you've got a couple of outliers where there's a lot of supply slated to come in. Nashville being one of those markets, Miami being one of those markets, Dallas being one of those markets. Yeah. But for the most part, we're not seeing big supply growth in most of the top 25 submarkets in the U.S. So, I think what we're going to see happen is a lot of those projects are going to phase out and never come to fruition. But, and I think the ones that do, it's going to take a while for them to break ground. Getting capital together on the equity side and development, like we talked about earlier, is challenging right now. So, there's kind of two prongs that are putting pressure on the pipeline. One being they can't get capital, they don't have the equity to bring the project forward. The other side being, with construction costs elevated, interest costs higher than when they started on the project, the deal's just not penciling. And I think for those deals that aren't penciling, it's going to be tough to get in a position where they do, right? Because if you look, what's RevPAR going to be? If you look at a project today that's not penciling, what are you counting on? Either construction costs coming down or RevPAR in the market increasing rapidly. Both of those things happening, I think, are going to be pretty challenging.
I couldn't agree more with you. If that's the basis of your hope and a prayer to get the project going, it's time to move on. Sell it to somebody who's actually got the ways and the means to make it happen. It's and it's funny how some of those projects get overinflated, and it's always, one more thing they want to add into the project. It's like, stop, please. You're not going to make any money.
The amount of rooftop bars that I've seen value engineered out of projects is astonishing.
Yeah. And I remember when, value engineering was a dirty word. Okay.
Right.
So, my friend, are you ready for our lightning round?
I am. Let's do it.
All right. Producer Danny's going to put 2 minutes on the clock. It's word association, just so the first thing that pops into your head, starting now. Favorite sport?
Paintball.
Nice. Corvette or Porsche?
Porsche.
Nice. Movie or play?
Movie.
Favorite band, group, duo, or solo artist?
Ooh, that's a tough one. I have to think about that. No effects.
Social media?
No.
Aisle or window?
Aisle all day.
There you go. Streaming or cable?
Streaming.
Hotel lobby?
Good bar.
There you go. Best restaurant in your city?
Best restaurant in my city. Cafe Monarch.
Nice. Vacation, international or U.S.?
With or without kids?
Either way.
International.
Nice. You did that with 51 seconds left.
All right.
There you go. Oh, hotel lobbies. They're one of my favorite places to go to. I love working there. I used to office up in Long Beach, and I used to make a joke that we were at the end of the runway of the Long Beach airport. So we were right there in the Kilroy Airport Center. Yeah. And there was me sitting in a room trying to get work done with 30 other people. And it's like, okay, this isn't working. They're coming into my office, out of my office, and love seeing them, being with them. But I couldn't focus on stuff. There's too many other conversations going on other subjects. So I used to get up and go to the Marriott down the street, sit in the lobby. And I found out it was one of the favorite Marriotts for a lot of the hotel brokers and various other people that were coming into SoCal. And, so I'd always meet them there and have lunch or something. But I got more work done there. And it was always about the story. You're watching the people come in and out. You're getting up to go grab that other cup of coffee from the Starbucks that's in there. And you're getting so much done and you're very productive. What are your feelings about hotel lobbies beyond the lobby bar? I mean, that's one of my favorite places too, but I think the design and, you're lending the money on these construction loans, so they better have a big wow factor. That's my opinion.
Yeah, I think especially when you're looking at, the soft brand segment, the luxury segment, they're all trying to make it a community space, right? Yeah. And make the lobby a lively space. And I'm not a designer by any means, right? I'm a finance guy, but what I like to see is that communal type of space where there's good places to sit, there's good places to network. You can get F&B service in the lobby, whether it's from a bar or, snacks, hors d'oeuvres, that type of a thing. One of my favorite lobbies of all time was the Ace Hotel in New York, the original. I thought they killed it on that lobby. I mean, that became a destination before work from home was a thing. Yeah. It was packed with locals working out of it every day, utilizing the coffee bar during the morning, utilizing the regular bar at night. And it was packed, it was lively, and it gave the hotel kind of its own soul, right? So that's what I look for. Another lobby that I could think of that I've always loved. I used to spend a lot of time in Hong Kong, and the Intercon in Hong Kong has this. I don't know if you've ever seen that property or been there. Has this gorgeous glass overlook of Hong Kong Harbor, and there's just seats everywhere, live music, always packed, great atmosphere. I mean, those are two examples I think of when I think of a great hotel lobby.
I love it. I think those are both great hotels. I have not been to Hong Kong, but I have heard nothing but great things about the Intercon in Hong Kong. So very
great
nice.
property.
Hey, Ryan, you got an open invitation to come back anytime you want. But before I let you loose today, how can people get a hold of you? Time for a shameless plug.
Yeah, go on our website, arribacapital.com. You can email me direct. Email is super easy. It's ryan@arribacapital.com. Would love to connect and chat.
Perfect. Thank you, Ryan. I'll talk to you soon.
Thanks so much, Greg. Take care.
Hey, that's it. Another great show. Give Ryan a call. He'd love to hear from you. Matter of fact, I'm going to talk to him in just a couple of minutes. I've got a couple of clients that I'm sending his way as well. But I do want to thank our good friends at Red Roof. Give Matt Hostetler a call. Let him know that producer Danny and I sent you. They'd love to hear from you. And conversion opportunities, soft brand, their extended stay, and their world famous economy brands as well. And then again, on March 5th and 6th, 2025, the 8th Annual California Lodging Investment Conference. I can save you $200 right now for a limited time. You register at CLIconference.com and use the word early as a promo code, all uppercase. So get registered and join us in March for CLIC 8. And as I'm fond of saying, be kind, share your knowledge, go be amazing.